Welcome back to the deep dive. Today we're tackling one of the most persistent and honestly painful questions in finance.
Big one, right?
The big one. When a trader has this wild success, is that genuine, repeatable skill?
Or is it just luck? Just, confidence masking randomness.
It's the ultimate paradox.
It really is. And to kind of frame that conflict between perception and reality, we have to start with Kurt Vonnegut Jr. He told this incredible story in Slaughterhouse-Five about Earthlings who get kidnapped by aliens.
Right, and they're put on display in a zoo on planet Zircon 212.
Exactly. And in this zoo, the aliens give them a fake stock board and a fake phone.
So they think they're actively managing a fortune, they're making calls, they're tracking prices, celebrating their own genius when things go up.
And then tearing their hair out when it crashes.
Yeah.
But the catch is, the prices are totally rigged.
The Zirconians are just manipulating it all for a good show.
The profits and losses are meaningless, but the emotional performance is completely real. And if you believe the markets are truly efficient, then a successful trader might be suffering from that exact same delusion.
Believing their success is skill when they're just a lucky exhibit in the zoo.
That's a harsh way to put it, but yeah.
So our mission for this deep dive is to synthesize the wisdom of these legendary traders.
Yeah.
Michael Marcus, Paul Tudor Jones, Richard Dennis, and figure out, are they lucky performers?
Or do they possess a definable, learned craft that we can actually understand?
And what jumps out from the sources right away is that if it is a craft, it is definitely not an innate talent.
No, not at all. Early failure seems to be the rule, not the exception. You look at someone like Richard Dennis, who became famous for turning a tiny stake into a massive fortune. Early on, he was a runner on the floor.
Making, what, $40 a week?
Something like that, yeah, $40 a week. And he was routinely losing $40 an hour trading.
That math doesn't work out.
It doesn't. He blew up his small account multiple times. Michael Marcus, another titan, wiped out several times before he ever got it right.
So this suggests the whole journey is about learning not just market mechanics, but a profound psychological transformation.
A total shift in mindset.
Okay, let's unpack that. That transformation from, perennial loser to consistent winner. Michael Marcus himself admitted he started with no real grasp of trading principles. He just kept borrowing money and losing it.
Right, until he met the legendary system trader Ed Seykota. But before that, he wasn't talented. He was just incredibly stubborn.
He just refused to quit.
Exactly. You'd look up at the ceiling and ask himself, am I really that stupid? And the sheer force of asking that question, of refusing to accept failure, that seems to be the engine that drove him.
That persistence is vital, but it has to be tempered by accepting a painful truth, which is that the market doesn't care how brilliant your analysis is.
Oh, not one bit. We see this with Jim Rogers, who had this truly traumatic experience shorting Memorex at $48.
And he was fundamentally dead right.
Completely right. He knew the company was going to collapse, but the stock just didn't obey his timing.
Instead of crashing, it squeezed up.
All the way up to 72, he was leveraged, and the pain just got to be too much.
So he went broke before he could be proven right.
He covered his short at 72, took a massive account-wiping loss, and then he had to watch the stock collapse all the way down to $2.
Ouch.
The lesson, and every great trader repeats this, is that the market will always go higher and lower than you think it possibly can.
Your brilliant idea means nothing if your position size kills you first.
Exactly. Conviction is useless without capital preservation.
Which leads right into what Marty Schwartz realized. He said he only became successful when his desire to win became more important than his desire to be right.
That is a fundamental shift away from ego.
It has to be.
And Ed Seykota takes this idea even further into, well, some pretty radical territory. He has this belief that everybody gets what they want out of the market.
I want to just sit with that for a second. That's a wild statement. It suggests the biggest enemy isn't the market, it's us.
It's ourselves. Seykota suggests that for some people, the drama of failure is the subconscious payoff.
You mean they get excitement or sympathy?
Yeah, sympathy from friends, attention. They get to be the tragic hero. In a really perverse way, they win by losing money.
So he actually saw this happen.
He watched one client consistently double his account and then, like clockwork, dramatically change his personality and lose it all back. The losing fulfilled some deep need that the winning never could.
Wow. So if you want to escape that Zircon 212 delusion, the first step isn't reading more charts.
It's making sure your deepest psychological needs aren't being met by self-sabotage.
Okay, so once you've cleared that psychological ground, what rules do you actually follow? This gets us into methodology.
And the classic system versus discretion debate,
Richard Dennis tackled this head-on with his famous turtle experiment.
right? He wanted to prove that trading skills could be taught. So he took complete novices and gave them a codified set of rules, a systematic approach.
And it worked frighteningly well. It was proof that a mechanical system could work if you just had the discipline.
Precisely. And Dennis later said that the key wasn't the secret rules. He claimed he could publish his entire rule book in the newspaper.
And people would still fail.
They'd still fail to follow them. The hard part isn't knowing the rules, it's the consistency. It's executing them when you're in a drawdown and your emotions are screaming at you.
But not everyone is a system trader. You have guys like Bruce Kovner.
A completely different approach. Highly discretionary. He relies on fundamental analysis, understanding the why a market should move.
And technicals are just for timing.
Exactly. He uses technical analysis just to clarify his fundamental view.
Then you've got Marty Schwartz, who's the complete opposite.
A perfect illustration of the point. He was a losing fundamental analyst for years. He only became successful after he switched almost entirely to technical analysis.
So the lesson is, find what works for you. There's no single right way.
No one size fits all. It has to fit your psychology.
Okay, so if the methodologies can vary so much, what are the sort of general principles that stand out? Trend following seems huge.
It is. Richard Dennis's core principle was simple. Go with the trend, and the stronger the trend, the better. In the commodity booms of the 70s, this often meant trading on limit-up days.
Okay, can you just quickly clarify what a limit-up day actually is for someone who doesn't know?
Sure. A limit-up day is when a commodity hits the maximum price increase the exchange allows for that day. It signals frantic buying.
So you literally can't buy anymore until the next session opens.
Right, and riding that wave takes incredible nerve, but that's where the huge money was made in trend following.
That makes sense. But we also see a lot of contrarian thinking, too.
Absolutely. Paul Tudor Jones learned from his mentor, Eli Tullis, that markets look their absolute best when they're setting new highs.
And that's a good thing.
Well, Tullis said that's often the best time to sell. It encourages flexibility. Jones himself would flip his opinion in a heartbeat. If he was bearish but the market refused to go down, he'd turn bullish.
Market action overrules your opinion.
Always.
And Michael Marcus had a brilliant tool for spotting those potential turning points, the relative weakness signal.
This is such a great insight. Imagine a time of massive inflation. Every single commodity is screaming limit up every day.
Everything's on fire.
But you notice one market, say cotton, only finishes marginally higher. That relative weakness, its failure to perform when everything else is rocketing, is a huge tell.
It's signaling a market peak, an opportunity to short.
You want to find the one thing that's acting terribly compared to its peers.
We see a similar idea, but in reverse, in stock trading with William O'Neill.
With his can-slim method, yeah.
Yeah.
David Ryan used that to generate just phenomenal returns. And the rule is explicit: don't buy near the lows.
Buy stocks coming out of big bases and making new highs.
Ryan's mantra was basically, buy high, sell higher. He wasn't looking for bargains. He wanted what was already working.
And a key filter was relative strength, preferably above 80.
Right. And for you listening, an 80 relative strength score means that stock is outperforming 80% of all other stocks in the market. You're buying the leaders.
And that avoids the trap of the bargain hunter who buys something cheap only to watch it get cheaper.
That's the psychological trap. You want to see institutional momentum, and that often happens at new highs.
So how did he filter out the false breakouts when a stock pops to a new high and then just immediately collapses?
He used a volume filter. During the consolidation, the sideways period, volume should dry up.
Showing the weak hands are gone.
Exactly. They've been shaken out. Then, when the stock breaks out to that new high, volume has to surge dramatically. That surge confirms that big institutional money is driving the move.
It really sounds like whether you're trading bonds or beans or stocks, the underlying mechanics are the same.
That's what Richard Dennis concluded. He said, I could trade without knowing the name of the market.
Because you're just trading human emotion.
Greed and fear. Mass psychology. Those principles are universal.
Which means if the method is about patterns of fear and greed, the final and most critical piece has to be about self-preservation.
Risk control, absolutely.
Every single successful trader stresses the same rule.
Hold on to your winners and cut your losers. Ruthlessly.
Right.
If you don't stay with the few big winners, you can never pay for all the small losses.
Bruce Kovner's story here is so instructive. The closest he ever came to going bust was because he was insanely leveraged.
On a spread trade, of all things, which is supposed to be lower risk. But he was over-leveraged, and one side of the spread went limit down.
Which means the price dropped the maximum allowed and he was completely trapped.
Couldn't get out, couldn't liquidate, couldn't control the damage. That near-death experience taught him his one non-negotiable rule.
Always have a stop.
Always have a predetermined stop-loss before you even enter a position. You decide the maximum you will lose before you even think about what you might gain.
And he said a lot of brilliant traders failed because they just traded much too big.
Position size is the ultimate killer of talent.
Which brings up Marty Schwartz's fascinating rule. He would cut his position size not only after a big loss, which makes sense.
But also after a big winning streak.
Right. Why would you penalize success? It seems counterintuitive.
Because he learned that complacency follows success. His biggest losses historically came right after his biggest gains.
The winning streak bred arrogance.
Arrogance, sloppy trading, oversized positions. So by cutting his risk after a big win, he forced himself back into a disciplined, cautious mindset.
Larry Haight seems to provide the most systematic approach to all this.
His whole philosophy is survival. You cannot quantify reward, but you absolutely can quantify risk.
His principles are simple. First, never bet your lifestyle.
Second, always know the worst possible outcome before you trade. He said that knowledge gives you tremendous freedom.
Freedom from emotional reaction, I assume.
Precisely. His firm, Mint, had a rigid rule. Maximum risk on any single trade was just 1% of total equity.
1%. So if they have $1 billion, they're risking only $10 million on any single idea. That's incredible discipline.
It is. And that anecdote about the coffee expert just crystallizes his entire point.
Oh, tell that one.
Haidt visited this coffee expert who knew everything. The supply chain, the weather in Brazil, the politics, the boats, the entire universe of coffee.
And he lost a fortune.
Blew out $100 million. Haidt asked him, how did you trade it? And the expert was confused, asking Haidt, you don't know anything about coffee.
And Haidt's reply was what?
I just look at the risk.
The expert knew everything about the reward, but nothing about the risk.
And it cost him everything. Which brings us to the final warning from all these sources. The leading cause of financial failure is believing you can rely on the experts.
Right. Michael Steinhardt warned laypeople to recognize that trading is a very competitive business. You're up against professionals who have 1% risk rules and a deep understanding of psychology.
You really are.
So we've gone from the Zircon 212 delusion to the meticulous, disciplined process of the world's best. What is the core insight here?
I think the deep dive really reveals that success in trading relies less on some unique predictive power, a crystal ball.
And more on psychological resilience.
And extreme discipline and, frankly, meticulous, boring risk management. It's the least glamorous parts of the job that define whether you survive.
So if all the successful traders say the same things, cut your losses, ride your winners, always use a stop, what's the ultimate challenge for someone learning this?
Well, it goes back to Richard Dennis. He said you could publish all his trading rules in the newspaper and still no one would follow them.
The knowledge is out there, but the application isn't.
The application is the hard part. And this raises the final question for you, the learner. If the mechanical rules for success are public knowledge, what deep-seated beliefs or psychological barriers, as experts like Dr. Van Tharp suggest, are stopping you from adopting that discipline? Because the real work, it seems, isn't mastering the markets.
It's mastering the person who's creating them.